And this is Bloomberg Technology. Coming up in the next hour, Qualcomm falls. Shares of the chipmaker plummet on weak smartphone demand and a downbeat forecast. We will discuss the impact of trade tensions. Plus, Spotify's podcast push. The streaming music company says its podcast bet is paying off, but shares fall on its latest earnings report and a subscriber miss. And Wall Street grills WeWork. On its investor day, the office space giant faces questions about its finances. We will get a read on investor appetite ahead of a potential IPO. But first to our top story, shares of Qualcomm falling in after-hours trading after the chipmaker gave a downbeat fourth-quarter sales forecast. At the high end, Qualcomm is looking at $5.1 billion in sales, while analysts predicted $5.7 billion. That's in line with a warning issued by Qualcomm back in April that demand for smartphones, particularly in China, would be weak ahead of the introduction of 5G. Joining us to discuss in New York, we've got Bloomberg Senior Markets Editor Mike Regan, and in LA, Sarah McGregor, who leads Bloomberg's U.S. economic policy coverage. So, Mike, first of all, explain what we're seeing driving this drop. How much does it have to do with China?
Well, like you said, that revenue forecast for the current fiscal fourth quarter was very light. The EPS forecast for the quarter also really light. They see adjusted EPS of as much as 75 cents. The Street's looking for about $1.10. It all sort of boils down to Qualcomm's basic business model. You know, it has this controversial practice of instead of just selling chips to manufacturers, they license chips to them, and they want royalties equal to a certain percentage of the value of the device. Now, this has caused a lot of litigation problems for Qualcomm. They actually settled with Apple earlier this year, but there still are a lot of questions about a similar case brought by the Federal Trade Commission. The judge in the Ninth Circuit actually ruled against Qualcomm. They're waiting for an appeal, and there's just not a lot of clarity in today's earnings reports. They may be getting into it on the call as we speak right now, but not a lot of clarity about when they can sort of expect resolution on this idea. And that means, Qualcomm was very upbeat about the prospects for 5G in their earnings report, saying that their design wins have doubled over the last 3 months. But investors just aren't sure what that revenue stream is going to look like because of this unsettled issue with the FTC. And they also came out and said until they get a deal with Huawei over the same issue, it's unclear if Huawei will make additional payments to them. Also saying that Huawei is taking market share in China, which sort of has ramifications for the entire space. So Qualcomm's really been on a roller coaster ride this year, Emily. I mean, it's down about 18%, more than 20% now if these declines hold in the trading tomorrow. Still up about 29% on the year, so quite a wild ride for Qualcomm this year.
Quite a roller coaster for Qualcomm over the last couple of years, given the attempted Broadcom takeover as well. They also had to cut off supplies, or at least some of their supplies, to Huawei after the Trump administration blacklisted it in the midst of the trade war and national security concerns. Sarah, give us the latest on talks between the U.S. and China. We know they've ended. We know there's a new set of talks on the calendar for September. Do we know if they agreed on anything?
So we were left with very few clues about what was actually discussed at this meeting. What we do know is that, the officials really just met for about half a day, and they've said, they're going to reconvene again in September, which is, weeks away. And beyond that, they described the talks as constructive, but there was no real indications of concrete progress that was made. And what I really think, if we listen to the analysis that's coming out in the hours since these talks have ended, is that it seems like the sides are sort of settling in for a bit of a slow burn in the negotiations from now on. The fact that they're not sort of doing a lightning round of negotiations out of this out of these meetings in Shanghai that just ended suggests that things aren't at an accelerated pace at this point. And I think there was some speculation, and even Trump himself, that these talks could extend up to or even past the 2020 elections. And I think that doesn't seem like an unlikely time horizon at this point.
So, Mike, what does this mean for Qualcomm? I mean, more uncertainty is something I assume investors won't like.
Yeah, absolutely. I mean, especially in the chip space, there was quite a rally in chip stocks since the G20 meetings when it seemed like there was some progress being made. It doesn't seem like there was a huge sell-off in chip stocks because of these recent Trump tweets that, as Sarah indicated, make it sound like these negotiations could drag on past the election. And I think that's largely because while that's happening, tensions are not exactly escalating. He has not sort of made any threats of new tariffs at the moment, but obviously that's something that could change day by day. For the moment, though, I mean, chip stocks, it's been a very noisy quarter for chip makers because of the trade tensions. As Intel said, some customers actually accelerated purchases of chips earlier in the year in order to get ahead of what they considered to be an escalating trade tension situation. So it's definitely causing noise in the earnings report. It's not really the first thing companies are talking about, but that obviously could change if it does look like tensions are going to ratchet up, that potential more tariffs could be in store.
So, Sarah, what is the likelihood we're in for the long haul here and this drags into 2020 and past November?
Increasingly, it looks like there really is no quick solution to this trade war. And even if there was a sort of a provisional deal or a halfway deal, it's not clear that the Trump administration would go for that. It's really promised to get tough on China. It's hard to imagine that Trump would go back on his re-election bid and say he got anything less than wide-scale reforms to China's economy and sort of brought them to their knees. And so it might be a safer bet for Trump to just sort of continue the negotiations, hope that the economy ticks along. He got his rate cut today, whether it was big enough or not, that'll definitely help keep the economy chugging. And so I think, this might be a safer strategy, but again, we'll have to see day by day how things play out. And in the meantime, the Trump administration's still moving forward. We have these export controls. They're looking at emerging and foundational technologies. There's a lot of other strings that they can pull that can have some impact on China that may sort of put them in the corner as well.
All right, Bloomberg's Sarah McGregor and Mike Regan, thank you so much for that additional context there. Thank you. Coming up, Apple looking at life beyond the iPhone, where its services and wearable businesses are going next. This is Bloomberg. Apple generated less than half of its total quarterly revenue from sales of the iPhone for the first time since 2012. It is a sign the company is entering life beyond its flagship product, but the move isn't as easy as it may seem. In order for life beyond the iPhone to be successful, Apple will need to keep selling the smartphones or make its music, digital pay, video, and other services usable and good enough for those on rival mobile devices to switch to Apple services. To discuss, we're joined by D.A. Davidson analyst Tom Forte, who's got a buy rating on the company. So, Tom, what's your take, first of all, on the now shrinking part of the pie that the iPhone has?
So the good news for Apple is that they've got investors to focus on what's next for Apple, and you just touched on a lot of it. But I think as you saw today in Qualcomm's earnings, you have a mature market for smartphones, and you've seen it in the iPhones with declining unit sales the last couple of quarters. And I do anticipate that that'll be the case until we have a 5G device likely next fall. But for Apple, really, it's about payments. It's about financial services, beyond payments, healthcare, as you talked about, premium video content, advertising, but done in a way that protects the privacy of the consumer. So I think the story for Apple, either the services story or the non-hardware story, depending on how you want to phrase it, it's a good one. And I think that investors are warming up to it, which is why the stocks rebounded so significantly after that earnings pre-announcement late last year.
But they do go hand in hand. In order for people to use the services, they need to be using the iPhone. And in order for more people to use the services, perhaps more people need to be using the iPhone. How does Apple continue to drive both things in the middle of a smartphone slump?
Yep. So the key for Apple is then their installed base. But the good news is it isn't as if iPhone users are switching to other devices. They're just holding on to their iPhones for an extended period of time. And then again, to the extent that we have a catalyst on the horizon, what would inspire these iPhone users to upgrade? It's a 5G device. That looks like it's going to happen next year. So again, so long as they can maintain their installed base, keep people using Apple products, then I think it's easier to overlay the services on top of it, either premium news, premium video content, etc. And I think that has the stock really well positioned here.
Now, we were speaking to a guest yesterday, Om Malik of True Ventures, who said many of Apple's services are pretty mediocre. There are some that are doing increasingly well, like Apple Pay. Do you see Apple being able to Appleize, some of these other services and make them great, like they have done some of their hardware products?
Yeah, so A, that's an excellent question, and B, we certainly don't think mediocre when we think Apple. So if you look at the premium video content, they've certainly lined themselves up with A-plus Hollywood talent when you think of Oprah Winfrey and Steven Spielberg. You bring up a great point on Apple Pay. So some years ago, if we were having this conversation, my expectations were really low for Apple Pay, so they've far exceeded my expectations. And then part of what they're doing in hardware is more than the smartphone, to the extent that you're seeing strength in wearable devices such as the Apple Watch. So I am a believer that, generally speaking, low quality and Apple don't go hand in hand. So I would never think of their products or services as low quality. I think of the A-plus Hollywood talent they have. I think of the success they've had with Apple Pay, and I expect that to, extend to some of their other products and services.
Now, looking out into the future, do you see the iPhone continuing to be a shrinking part of the pie, and how low does it get in terms of a percentage of revenue share?
So another excellent question, and absolutely. So I think for Apple to be successful 5 years from now, smartphone sales may have to be less than 1/3 of total revenue. And then the big question, if we had this conversation, say 6 to 12 months ago, was where is Apple in the smart home? Because the concern was, and I think there's still a concern today, that either Alexa devices or Google Assistant devices will dominate the Internet of Things within the connected home. So the HomePod, I think, was disappointing for Apple. So we'll see if there's another way for them to, go after the connected home. But I think a healthy Apple 5 years from now generates less than 1/3 of their total revenue from smartphones.
Less than 1/3, coming down from 2/3. Tom Forte, Senior Research Analyst with D.A. Davidson. Tom, always good to have you here and your insights on the show. Coming up, Spotify out with its second quarter earnings and a miss on subscribers. CEO Daniel Ek saying, quote, "That's on us." We discuss the music streaming company next. This is Bloomberg. Spotify shares fell the most in almost 5 months Wednesday after reporting slightly slower subscriber growth than what investors had hoped for. The music streaming company reported it ended the most recent quarter with 108 million subscribers to its premium service, a shade below the 108.5 million forecast. Bloomberg's Lucas Shaw, who covers Spotify, joins us to discuss. So, Lucas, what happened?
Investors see Spotify as a growth story, a momentum stock, and that's what CEO Daniel Ek has sold them on. And so that means that every quarter they expect Spotify to not just hit their numbers, but usually to beat them pretty considerably, as, say, another streaming company like Netflix has tended to do quarter after quarter. Spotify's problem in its earnings has been that it tends to be pretty good at forecasting, and so the numbers that it reports are either they meet what they say, they're slightly above, or in this case, slightly below, and investors almost always react negatively. I think their stock has traded down 4 or 5 of the 6 times they have issued earnings as a public company, even though on the whole their stock has been doing just fine this year.
What does the podcast bet have to do with it? Spotify says it's working, but clearly not enough to beat the estimates.
Well, one of the challenges for Spotify is unlike some of the companies in video streaming, Spotify has fixed costs. So of the $9.99 or $6 a month, whatever it is that it collects from you, a majority of that goes directly to music rights holders. So Spotify is trying a lot of different things to reduce the cut that it pays to rights holders that can make it more profitable. One of the ways it's trying to do that is what it calls a two-sided marketplace, which is selling tools and services. And another is podcasting, which is opening up a whole other area of audio programming. The issue right now is that it can't carve out podcasting from its revenue pool. So podcasting mostly just adds to its costs at the moment because there's not a good way to make a bunch of money from it. There's not good advertising products or technology around that. And subscription-wise, it's not saving it any money. So it's just sort of a good talking point for them right now, nothing that makes the difference in terms of their numbers.
How is competition shaping up? Is Apple Music eating into the pie?
They say no. Apple Music has grown quite a bit, But Spotify grew 30-something% year over year, and they say that based on the numbers they've seen from Apple, Apple is growing at half that rate. Amazon has grown too, YouTube has grown a little bit, but Spotify is still pretty clearly the market leader. I think the big question for the company, for investors, for analysts is how long is this growth going to continue? Is this a 5 years of unimpeded growth, or is it going to slow down more quickly than that? And can they find a way to reduce the cuts that they pay labels, whether it's podcasting or some other means?
All right, Bloomberg's Lucas Shaw for us. Thank you for that context. Now, after a year and a half of searching for the home of its second headquarters, Amazon chose to split its campus between Crystal City, Virginia, and Long Island City, New York. Shortly after the decision was made, we watched the downfall of the New York campus as local politicians pushed back and Amazon pulled out. Since then, U.S. cities have upped the ante to try and persuade the Seattle giant to bring new jobs to other locations. One city that did make out from the start is Nashville, Tennessee. Amazon announced that its operations center of excellence would be moving to the city to the tune of 5,000 jobs. We caught up with Tennessee Governor Bill Lee and asked him about the move and how he plans to bring other big tech giants to his state.
We're a state that has a very business-friendly environment. We have no income tax. We have very low business taxes. We have a regulatory environment that's friendly to businesses. So companies know that about states. We're very fiscally soundly managed. Companies know that, so they sort that out. Then they look at incentive packages that states have to offer, and we certainly deal with companies in that way. We incent companies to come there. Then they look at things like workforce development. And we've made a tremendous push in our state to create workers for companies that are coming there, particularly tech companies and technology-based companies. Our administration has done something called a Future Workforce Initiative that's establishing the kinds of education curriculum and pathways that will create the workers for the future.
There are some tech companies that are already there. Lyft has operations there. Postmates, Mitsubishi has moved some operations there. What in the future do you think you can offer tech companies? I mean, you're obviously making the case here in San Francisco this week to put a bet on Tennessee.
Yeah, I think the biggest thing that we can do is show to them our commitment for workforce. Technology-related jobs require a workforce of the future, and they require an education system, I believe, that understands the needs of that workforce. And we created something called the GIVE Act, the Governor's Investment in Vocational Education Act this year, something called the Futures Workforce Initiative. Those are legislative initiatives that in fact create workers of the future. It changes the way our middle schools and high schools look, and ultimately changes the type of skills that people and workers in Tennessee have. We need to be a place that when Lyft is looking to expand their operations in Tennessee, that they know that they can add the 1,000 jobs they need to, or Amazon will know that the 5,000 jobs that they're going to need to fill, that there'll be a workforce out there to do it. So our investment in that's really important.
Nashville voters just overwhelmingly rejected a transit bill that would have brought light rail to the city. Do you see a risk that Nashville or Tennessee might not learn the lessons of Seattle, which saw rising housing costs, a traffic crunch because they didn't move fast enough when Amazon came calling?
Right. Yeah, we have to lead on this. What I think is most important that we have to do, and we're talking about this in our Department of Transportation now, but with other municipal leaders, we need to think about what transportation is going to look like in the future. You know, investing in a multi-billion-dollar system that may be antiquated by the time it's built is not what we want to happen. I think transportation is rapidly changing. If you talk to some of the companies here about how people are going to move, that's what we need to be investing in from a transportation standpoint. We do have to stay ahead of that curve. In our major cities in Tennessee, we want to be ahead of the growth curve as much as possible so that we can not make the same mistakes that other cities have had to make and had to learn. We want to learn from their mistakes and not remake them.
Now, as we're having this conversation, you've got Capitol Hill increasing scrutiny of big tech. You've got the Department of Justice, the FTC opening antitrust reviews into big tech, the FTC looking at Facebook specifically. Do you think Facebook, Google, Apple, Amazon, do you think these companies are too big?
Oh, you know, what I think about these companies, first of all, I think Washington has an opportunity and they have a role they play in the kinds of topics you're talking about, but I'm a business person who sees these companies primarily as an opportunity to create jobs. And when the market allows them to grow and to flourish and to create more jobs, then that's good for states like Tennessee. If they're in our state and they're growing and flourishing, I think that's good.
What would you say to those who say these companies are stifling innovation or need more regulation?
You know, I think that there's an appropriate place for regulation in our world. That's part of what, for safety, for protection of rights. That's really important that we look at that. But at the same time, you know, government needs to stay out of businesses to the degree that they can. There's a real right balance there, and I think we have to find that balance. But I'm a free market person who believes that businesses, when thriving, are really good for the economy, really good for jobs.
Our conversation there with Tennessee Governor Bill Lee. Well, if you want to short Beyond Meat, you'll have to pay for the privilege. The cost of shorting the veggie burger maker is now the highest among all U.S. stocks. Beyond Meat has risen more than 700% since its IPO in May. Almost 45% of the company's free float has been borrowed for short selling. Coming up, testimony in age discrimination claims against IBM indicate the company may have fired as many as 100,000 workers in recent years. Details and reaction from the company next. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Well, it finally happened. The Fed delivering its first interest rate cut in over a decade. Here's Fed Chair Jay Powell announcing the news Wednesday.
We decided today to lower the target for the federal funds rate by 0.25 percentage point to a range of 2% to 2.25%. The outlook for the U.S. economy remains favorable, and this action is designed to support that outlook.
The news sent U.S. equities into the red, fueling speculation the central bank is not necessarily at the start of an easing cycle. To discuss, I want to bring in Bloomberg's Pim Fox in New York. And Pim, the president tweeting his displeasure, saying, as usual, Powell let us down, but at least he is ending quantitative tightening, which shouldn't have started in the first place. No inflation. We're winning anyway, but I am certainly not getting much help from the Federal Reserve.
Right.
What does this mean for tech?
Well, you're right, Emily. I mean, you know, it's that combination of times when economic news and financial news is somehow always combined with technology news, particularly when it comes to President Donald Trump. And as you mentioned, perhaps he was looking for more than just a 25 basis point rate cut. And in the press conference that Jerome Powell gave after the Federal Reserve's decision, there was a little bit of sort of back and forth in terms of the wording that he used, because he at one point talked about how this was not the beginning of a rate cut trend. So then you started hearing the quote around the newsroom and the trading rooms, one and done. Does this mean then that the Federal Reserve will not be cutting rates in any additional way between now around the end of the year, something, of course, that the president has said repeatedly that he wants to have happen. So that also helped to send stocks lower, but the notion being that if this is just a 125 basis point cut, will that be enough in order to sustain stocks move higher? Plus, you're seeing that comparison go on between rates in the United States and rates in other developed nations. In many cases, they're negative. So on a comparative basis, it still looks as if the U.S. is expensive. And what was interesting, actually, Emily, was the dollar rose as a result of the rate cut. So it was supposed to really go the other way, but DXY, the index of the U.S. dollar, moved higher. And that's the opposite of what the president has previously tweeted that he wants. He wants a weaker dollar and is concerned that China, as well as the European Union and the ECB, are in a way keeping their currencies cheaper than the dollar for competitive reasons.
Meantime, you've got a number of tech companies that we don't talk as much about on this show having big moves for story-specific, company-specific reasons. Beyond Meat, as I just mentioned earlier, up almost 700%. There was a little bit of a blip on news of a secondary offering. AMD, FireEye. Tell us what's going on in terms of their individual stories.
Okay, well, Beyond Meat, I think, almost speaks for itself, and it's beyond rational to a certain extent, because while sales are great and then the company is generating a lot of positive publicity, and as you mentioned, Emily, the company did come out just during its earnings announcement the day before yesterday that they were going to raise more money by issuing more shares. Well, of course, that ends up diluting the existing shareholders. But having said that, it is still a small company when you compare it to, like Archer Daniel Midland or, any of the big ConAgra, any of the packaged food companies. But this has really taken off onto a life of its own. And it reminds at least some of the investors that I spoke to, it reminds them a little bit of Tesla, where you have this big public excitement, but then when you sort of look at the actual numbers involved, it is not necessarily a company that should enjoy that level of market capitalization. On the other hand, we talk about chips. You mentioned AMD, Qualcomm. Let's begin with Qualcomm, only because Qualcomm and Huawei are seemingly linked, because Qualcomm is still waiting to get paid for a variety of products that Huawei sells in China on behalf of Qualcomm. Qualcomm is seen as a bet on 5G. I know you've covered that extensively, but the 5G story has to do with chips that do everything from measure the efficiency of the battery usage to the ability of the device to use both high frequency and medium frequency spectrum. And Qualcomm really has a big advantage there. But trade disputes with China, battles with Huawei, that's not something that sat well with investors. And Qualcomm came over and said, we might not be able to meet our earnings estimates.
All right. Lots of big moves. Pim Fox, thanks for breaking it down. Pim, good to have you with us. Well, IBM has laid off as many as 100,000 workers in the last few years, according to a recent lawsuit. In fact, Big Blue is facing several lawsuits claiming age discrimination against older workers. In one suit, a former employee alleges it was all part of an attempt to make IBM appear, quote, cool and trendy as it tries to appeal to millennials. Bloomberg's Olivia Carville joins us now with more from New York. So, Olivia, there are a number of different lawsuits here. Talk to us about the allegations.
Yeah, we have a varying number of lawsuits. We've got a class action lawsuit that was filed in Manhattan and different civil suits across the country from California, Pennsylvania and Texas. And the similar thread between all these cases is that they're alleging IBM has been firing its older employees in order to bring in and retain new younger workers. They actually call these cases or a fire and hire discrimination scheme. And they allege that IBM has been carrying out this kind of resource action, which is the term the company uses for laying off employees, since as far back as 2014.
So IBM, in a statement, said we've reinvented IBM in the last 5 years to target higher value opportunities for our client. The company hires 50,000 employees every year. Tell us a little bit more about how the company is responding.
So IBM is an 108-year-old company, and for the past 7 years straight, it's faced fading revenues. And it's been trying to reinvent itself. It's kind of totally missed the mark in the cloud computing revolution and has been lagging behind the likes of Amazon and Microsoft and Google for about a decade now. So the company's really on this new growth trajectory. It's bringing in hybrid cloud and trying to become a whole different company that focuses on newer technologies like artificial intelligence and hybrid cloud, and it just acquired Red Hat in a $34 billion acquisition. So part of the strategy of laying off older workers and bringing in new younger workers is actually to turn the company around and to become as we read in this deposition, a cooler, trendier company where young talent would want to work for IBM in a similar way that they want to work for a Google or an Amazon.
All right, Bloomberg's Olivia Carville for us in New York. Thank you. Well, Hulu is deepening its ties with the Walt Disney Company. In the wake of the Disney-Fox merger, the Hulu Scripted Originals team is joining Walt Disney Television. Craig Erwich, Hulu's Senior Vice President of Scripted Originals, will now report to Dana Walden, Chair of Disney TV Studios. This amid speculation over whether Disney can create compelling original TV shows not tied to existing licensed titles as it launches its own streaming service. In May, Bloomberg reported that Disney could take full control of Hulu in a deal with co-owner Comcast. Coming up, while Jeffrey Epstein could be waiting up to a year to go to trial in the midst of sex trafficking allegations, Silicon Valley executives are wasting no time distancing themselves from him. We will discuss next. This is Bloomberg. Jeffrey Epstein, the financier facing charges of sex trafficking underage girls, has long claimed a social circle of the powerful in both Washington and on Wall Street. But there's a different group of elite now distancing themselves from even the briefest encounters with Epstein, the investors and entrepreneurs of Silicon Valley. To discuss in New York, Bloomberg's Shonali Basic. And Shonali, the way these contacts came about is Jeffrey Epstein's little black book, his contact list of addresses, which included a lot of names that we recognize here in tech. Tell us.
Certainly, you have Sergey Brin, you have Richard Branson, you have some people who the relationships had gone back a long time, but they were only marginal relationships. It wasn't things that they had seen him and hung out with him a lot. By the way, Bill Gates was one of his calling cards. He would say he did tax services for Bill Gates, and that's something that when you look at the financial community, they say, well, this guy must have had services for Bill Gates. He must have been all right. But then Bill Gates' spokesman told us today that, you know, that's not really true, that he may have spoken to him once or twice in a philanthropic context, but there wasn't any real work done for Bill Gates by Epstein.
Right. Gates' people saying he never provided services of any type to Bill. The discussion that they did have focused on philanthropy. And just to be fair to these folks, Sergey Brin declined to comment. Richard Branson saying there's no personal or business relationship between the two, nor has there ever been. In another instance, Reid Hoffman hosted a dinner in Palo Alto for a famous neuroscientist where Elon Musk supposedly introduced Epstein to Mark Zuckerberg. So all three of them then get pulled into this discussion. Reid Hoffman saying he's had only limited contact with Jeffrey Epstein, and it was always at the request of academics and in the context of academic fundraising. Musk denied introducing Epstein to Zuckerberg and said he's, quote unquote, obviously a creep. A Zuckerberg spokesman said that they'd only met in passing and didn't communicate again. What are the implications, though, of even the hint of contact between these folks?
By the way, that dinner that you just referenced here, that was only a couple of years ago. And remember, that means that this was well after Epstein was declared a registered sex offender. And so that's really what's at stake here. You look at, in New York as well, you have a massive private equity firm, Apollo, whose co-founder had a deep-standing relationship with Jeff Epstein. And their own investors now are saying that carries a reputational risk. So say you're a venture capital founder and you had a relationship with Epstein in any sort, your LPs might be asking the question, why? Why, especially if it lasted past 2009 after he was a registered sex offender. In 2000 and, actually just as early as last year, you have this instance in the story here by Sarah McBride that the Code.org founder had tried to have a conversation with Epstein about potentially donating some funds, and he did his research on who it was and then decided not to take the money because of knowing who he was. But a lot of these relationships were well before 2009, so it's really the relationships after that mattered the most.
Right, Hadi Partovi saying he turned that money down, right. But it's fundraising is tough. All right, I'm sure this story will continue to evolve. Bloomberg Sonali Basak, thank you so much for joining us. Coming up, Samsung, another smartphone maker caught in the trade war crossfire. How the economic slowdown is weighing on the South Korean giant. Next, this is Bloomberg. Samsung shares tumbled Wednesday after the company said second quarter profit more than halved from a year earlier. The South Korean company saw net income fall by 54% to $4.3 billion, while revenue dropped 4%. This amid global trade tensions and a wireless industry slump. The U.S.-China trade war has rattled the global tech supply chain and weighed down the price of memory chips. Joining us from Hong Kong to discuss Bloomberg's Selena Wang. So, Selena, these are pretty dramatic numbers, and coming off the heels of Apple's results, which weren't amazing, but certainly not this bad. Is this more of a Samsung-specific problem than something that has to do with trade or smartphone growth in general?
Well, we already received a profit warning from Samsung, so actually they beat some of the estimates on some fronts, but they did see falling net income, operating profit, and revenue. Now, the big story for Samsung has been an industry-wide story, and it's around these memory chips. The whole industry has really suffered from low demand, falling prices, part of that because of the overhang from the trade war, economic global uncertainties, as well as slowing demand from these data center players. But we did hear some positive news from Samsung on that front. They're expecting demand to pick up in the second half of the year. A big sign was that they said they expect these data center players to reconsider purchasing again. But we also did see declines in their mobile division, 42% decline in operating incomes. Of course, the whole industry has been dealing with problems there, but Samsung did say profitability was eroded because of intensifying competition in these low to mid-range markets. So some Samsung-specific issues, but they've also been dealing with a lot of geopolitical global overhangs.
So talk to us about how we think the U.S.-China trade war, the dispute between Japan and South Korea are impacting Samsung specifically.
Well, one of the biggest overhangs for them is how long this U.S.-China trade war is going to drag on for and how much is going to have a slowdown on global growth, which impacts, of course, purchases of smartphones as well as all of the components. The Japan-South Korea spat is also a huge concern from investors. There was a lot of questions from analysts on the call about how they're going to minimize the impact. And we didn't hear a lot of details from the executives. We know so far that they have enough components for now, despite the export curbs. But the problem is, if these do drag on, if they become even broader, how is Samsung going to find alternate suppliers? That's going to be very difficult, and it could lead to production issues. And on the Huawei front, that's actually a double-edged sword for Samsung. On one hand, as Huawei suffers from challenging demand abroad, that is a place for Samsung to come in on the smartphone sales front. But in terms of their very profitable chip business, that could be a big drag if Huawei is really damaged and unable to purchase as many components from Samsung.
Meantime, Samsung has also faced some branding issues. They tried to launch a foldable phone to much fanfare this year. There were problems with the phone breaking down. They pulled it back. How are those kinds of issues impacting demand for the Samsung phones?
As you mentioned, they've had a slew of branding problems, and they have been seeing declining profits in their mobile division. They also made a statement that smartphone shipments in the current quarter will be similar to April and June. That suggests that the launches of these new flashy phone models may be not as successful as some may be hoping for. But some of the bright spots in Samsung's earnings, one of them is the OLED displays. We saw Apple come out with earnings recently. They had very strong results, stronger demand than expected, so that is expected expected to be a bright spot to sort of support Samsung's earnings in this display screen area. Another bright spot that the executives touted a lot on the earnings call is the development of 5G and the growing demand for 5G chipsets. However, that is still very early stages, and there's a lot of skepticism among investors now about how that's going to play out for the rest of the year. But it's worth pointing out as well that another reason why there was such a negative share impact after their announcement was that they actually ended up delaying announcements in shareholder return plans until next year, citing some concerns to global growth and geopolitical uncertainties.
So what are you watching for Samsung when it comes to the second half of the year, the holiday quarter, which always tells us so much about how the company is actually doing?
We're definitely going to be watching to see how these new smartphone launches unfold. They are facing a lot of competition. They said so themselves in these lower mid-tier markets where there's a lot of cheap phones coming from China. We're also going to be watching for this memory chip demand to see if it really starts taking off. There's been a lot of talk from analysts and investors and Samsung themselves that this problem is starting to reach a bottom, and that in the second half, these data center players accelerating demand is going to start to play out. But again, the biggest issue for Samsung right now are these geopolitical problems that they can't really forecast themselves. Analysts asked them during the call, how are you forecasting the impact? And they said there's a lot of uncertainty. They're unsure themselves what's the best way to go about minimizing this. So despite how hard they may try to execute on their own plans, there's only so much they can control when it comes to these global spats.
All right, Bloomberg's Selena Wang in Hong Kong. Thanks so much for that reporting. Meantime, office-sharing startup WeWork hosted an analyst day for Wall Street Bank's Wednesday as the company prepares for an IPO. The company is reportedly looking to go public in September in what is expected to be the second biggest initial public offering of the year. WeWork said to be targeting a share sale of $3.5 billion and was last valued at $47 billion. Joining us to discuss, Bloomberg's Ellen Hewitt. So what do we know about this analyst day?
Well, we don't know a lot. We know that WeWork is hosting one today and that they've had analysts from different banks and firms come in and hear the pitch, learn about the WeWork business model, and try to get a chance to assess how they might be covering it. We know that they held it at a WeWork office in New York City, and that most of the analysts who attended had to sign NDAs to agree to not discuss what was shared until after the IPO.
How typical is this? I don't remember Uber or Lyft holding an analyst day before they actually started a formal roadshow.
Well, I'm not sure, but the situation is that the S1 for WeWork has not yet been made public. So we know that WeWork filed confidential docs with the SEC last December and said in April, announced that they had filed those documents, but we still haven't gotten to see them. The company is aiming to do an IPO in September. That's based on our reporting. So one would think that maybe there's a chance that sometime in the next month we might get the public flip. We might get to look at the documents that show WeWork's earnings, losses, all the nitty-gritty, which certainly many people are very excited to look at. It's been a company that's gotten a lot of attention for its unusual financial metrics, community-adjusted EBITDA, things like that. And people will be interested to look at some cold hard numbers.
So let's talk about what analysts are actually looking for. What are the questions they want answers to?
Well, I think they're trying to assess whether to look at this company as a real estate company or a tech company. And that's something that WeWork has gone back and forth on for many years about how it presents its identity. It wants to be seen as a tech company, in part because it's interested in getting that sort of multiple in the markets. And it would be like much more valuable proposition for WeWork to be seen as such. Of course, many people look at it and think this is a company that takes on leases, rents out smaller parcels of real estate, and should be considered more like a real estate company or an investment that is modeled more on how real estate models are done.
Meantime, you mentioned some of the unconventional metrics. There's also been some controversy around the founder and how much money has been taken off the table. What's the status of that?
Well, that's still just part of the story of WeWork that I think people are going to be trying to get their hands around when they're deciding how to value this company. So you mentioned the founder and CEO, Adam Neumann, has taken out loans against some of his holdings of WeWork, has also reportedly sold some of those, some of his equity in the company. He's also been known to have personal holdings of real estate that WeWork has then taken leases in. The company has made steps in the last year to try to resolve some of those perceived conflicts of interest, but it's something that I imagine is a big question on a lot of analysts and investors' minds of, is this a problem? Do we think that this might be a problem for the company as it goes public?
And do we have a sense of how much money they're making, if they're profitable? Do we know?
They're not profitable, but they like to present, that's why we talked about community adjusted EBITDA. That's a metric by which they see themselves as profitable on sort of a building by building basis. So almost what you might think of as the equivalent of a unit economics type approach, where you're looking at an existing building that has been in place for something like 12 or 18 months. Does that building itself make a positive profit? And they say yes, but it's certainly removing a lot of expenses that other people might think should be counted into the greater
Right, like all the rest of the
calculation.
buildings.
Yeah.
Okay, Bloomberg's Ellen Hewitt, I know you're going to keep us posted if we get that filing. Thank you so much for stopping by. And that does it for this edition of Bloomberg Technology. We are live streaming on Twitter. Check us out at Technology, and be sure to follow our Global Breaking News Network TikTok on Twitter. This is Bloomberg.